going to explain on how to answer question on provision and contingent liability or contingent asset, but I will show you first the summary to differentiate between provision and contingent liability. So basically we will be based on the three conditions here. First, present obligation, either legal or constructive, due to past event. Second is there is a probable outflow of economic resources, meaning that there is a the probability of a company to pay for the obligation. And the third one is the amount can be measured reliably. So in order to recognize it as a provision, it must fulfill all the three conditions here. However, if any one of these conditions is not met, therefore it should be identified as a contingent liability and therefore disclosed in the notes to the account. Okay. Contingent liability can happen first when there is a present obligation. Okay, so I put tick here. However, it does not fulfill either the second or the third condition. Okay, so the present obligation exists, but there is no probability of paying for the obligation. When there is no probability, meaning it is only possible. How can it be possible? It is when whether or not the company is paying for the obligation is depending on the outcome of other event. So it means that it is possible. And the common example that always relate to this possibility of paying this obligation normally relates to the court decision. Okay, when you are being sued, so whether you win or lose, depending whether you need to pay for the obligation is depending on whether you win or lose. So it means it is possible. Okay, however, if the lawyers give opinion, okay, that the chances of losing the case is more, it means that it is probable. Right? Okay. The third one, or maybe you have fulfilled the first, there is a present obligation and the outflow is probable, but the amount cannot be measured reliably. So no, you cannot recognize it as a provision. You have to show it in the notes to the account because any one of the condition is not met. Or it also happen when the first condition, okay, the first condition is already not met, when the obligation is only possible. In order to recognize it as a provision, it must be a present obligation. If it is possible obligation, then it is to be shown as a contingent liability. Alright, when we talk about ignoring the transaction is when the probability of paying the obligation is remote. It is not probable, it is not possible, means that it is remote, therefore that transaction is to be ignored, meaning that it will not be shown in the financial statement and will also not show it in the notes to the account. Alright, so that's the difference between provision and contingent liability. Alright, contingent asset is about money that you expect to receive. If there is a virtual certain that you will receive, right, you receive the payment or the asset, okay, we will show that in the financial statement. But if the chances is probable, you only disclose it in the notes to the account. And if the chances of receiving the asset is only possible or remote, then we should ignore the transaction. Okay. Now we will answer this question. Okay, Anis, a newly recruited account executive of Segaria, is facing a hard time to differentiate between condition of provision and contingent liability. So you have two situations here. First one, during the year 2014, one of Segaria Berhad employees was injured while working. So the employee took legal action and sought damages of 200,000. Segaria has taken legal advice and is confident that the entity will be held liable, but the amount payable is questionable. Now, when you decide whether it is a provision or contingentability, you always rely on the three condition here. You will decide based on the three condition. Okay, the first one, that is there any present obligation due to past event? Yes. What is the present obligation due to past event? That is when the employee took legal action. Okay, so the first condition is met. Is there any probable outflow of resources? Yes, we can say that is probable when the legal advice says that it is confident that the entity will be held liable. Okay, so here it also met the condition. However, can the amount be measured reliably? No, because the amount is questionable. It means that the third condition is not met. So when it is not met, it means that it cannot be recognized as provision, because provision need to meet all the three conditions. So when this is not met, so it should be treated as contingent liability. So the question asks for accounting treatment. This is how you answer. The transaction should be treated as contingent liability, which is you have to explain one by one. That is a present obligation due to past event when the employee took legal action on the company. There is also probable outflow of resources based on legal advice that the company may be held liable. However, the amount cannot be measured reliably as the amount is questionable. So that's why kita come out with this decision that the transaction should be treated as contingent liability. Satu tertinggal. Okay. When you say it is treated as contingent liability, how do you treat them? It should be disclosed in the notes to the account. Okay. Ni kenalah. Alright. B. Sometimes in November, a legal representative from one of its trade payable, Cempaka, issued a legal letter. The content of the letter indicates that Cempaka has filed a lawsuit against Segaria for its failure to repay the full amount of services that have been rendered to Segaria. So now it's actually the creditor who is suing the company, okay, because the company did not make payment. So the total amount involved would be 750,000. Segaria has been consulted with the company's legal advisor, who is on the opinion that Segaria could probably lose. So when you lose, it means that there is a probability that you are going to pay for the obligation. So we look at the three conditions one by one. Is there any present obligation due to past event? Yes, when the trade payable, the creditor file a lawsuit. So there is a present obligation. Is there any probably outflow of resources? Yes, because the legal advisor says that Segaria could probably lose this case. Kalau dia kata win, that means you are not paying. The company will not pay for the obligation for the legal suit. Okay, but it says here you will lose, that means you need to pay. So there is a probability of outflow of resources. And then can the amount be measured reliably? Yes, because it's stated here the amount is 750,000. So how do you answer? The transaction is treated as provision. Alright, there is a present obligation. So you mention one by one. There is a present obligation due to past event. When the trade payable sue the company, there is a probable outflow of resources when the legal advisor states that the company will lose the case. And then the amount can be measured reliably. Okay, so that's it for the accounting treatment. Okay, if the question asks for journal entry, so you need to show the journal entry, but journal entry that is only applicable is only for provision, because contingent liability has no journal entry, because it merely a disclosure in the notes to the account. Okay, so let's say if the question asks for journal entry for this one, so that will be journal entry for this one, yeah, provision. So it will be debit, legal cost, 750,000, and credit provision on legal cost 750,000. So legal cost here will go into expenses in the SOPL. Provision here will goes under liabilities in your SOFP. Okay, thank you.